somewhere in the 10 to 12-year-old range, we learned there really isn't a Santa Claus. But I think that we now have to realize that we were wrong. The kids were right. And Santa Claus is, of course, Jay Powell. And he's given the stock market and the bond market, frankly, both are going up at a pretty shocking rate here recently. So thank you, Jay.
On this episode of the What the Finance podcast, I have the pleasure of welcoming back David Haight, who's the Co-Chief Investment Officer of Evergreen Gavekal. So, David, thanks so much for coming back on the podcast today.
It's a pleasure and a privilege, Anthony.
And you will be the last interview of the year, so
Wow.
it's been a pretty
pressure.
yeah, exactly. No, I think everyone's winding down. They're ready to just have a nice positive listen to a nice positive interview, maybe. We'll see. But yeah, I guess I thought we could keep this quite broad to start with. What is your current thoughts on what we're seeing in the macro and the markets? You're just saying off air that the Fed have sort of, well, I don't know if these were your words, but sort of lit a fire underneath the markets, and it's just we've seen it go up and up the past few days. So yeah, what are you currently seeing?
Well, I think that when we were somewhere in the 10 to 12-year-old range, we learned there really isn't a Santa Claus. But I think that we now have to realize that we were wrong. The kids were right. And Santa Claus is, of course, Jay Powell. And he's given the stock market and the bond market, frankly, both are going up at a pretty shocking rate here recently. So thank you, Jay. Even though you could say his comments last week were balanced, but certainly the more dovish comments were the ones the market seized on. And as you're aware, the dot plot from the Fed is now, instead of 50 basis points of rate cuts next year, we're 0.5%, 75 basis points, 0.75%. But the markets are pricing in 150 basis points, 1.5% of cuts. So they're way, way ahead of the Fed. And I do think if you look at some of the commentary here recently this week, they're trying to kind of calm people down and talk them off of this, incredibly bullish type of run that they've been on. And, they've kind of let the genie out of the bottle, and it's going to be interesting. It's a bit surprising to me because I thought that Powell was more concerned about his inflation fighting legacy than he was in the financial markets and trying to prevent them from returning to anything close to normal value. But it could be that he is just so appalled by the prospect of Trump being back in the White House that he's really trying to do everything he can to get Biden reelected. And that's a little bit on the conspiracy theory, but I think there's some logic. I think there's probably multiple factors at work in why the Fed is trying to do what it's doing right now. And it could be that, due to their business contacts, they are legitimately concerned about a recession, even though the overall economy, the investment community is totally bought into the soft landing narrative.
Yeah, it's a good point. And I actually spoke to Grant Williams, who I think you know quite well, and he
Quite
said a
well.
very similar thing about how is this Jay Powell being worried about that potential and trying to help Biden in the election, which is, as you said, it's conspiratory, but who knows these days?
Well, certainly, I would say it's fair to say almost all of Washington, D.C. is not looking forward to a return of Mr. Trump to the Oval Office. But, if you go back to the 2018-19 period, and that's when Trump was totally harassing Jay Powell, trying to force him to get to negative yields like Europe had, which, of course, would have been a disaster. Of what the Fed did with interest rates too low for too long was already bad enough, much less having negative yields, which creates even more distortions. So it's a weird time for sure, but I'm making money. Our clients are making money. I guess we got to be happy. But for us, it's been terrific that this recent rally has helped emerging market debt. That's something that I've been pounding the table on for months. And these emerging market closed-end funds are actually as much or more than the stock market here recently. A lot of the corporate bonds that we've owned have also gone up more than the stock market. It's really been quite incredible. So I guess I shouldn't complain, or maybe I kind of half jokingly say I shouldn't look a gift reindeer in the mouth that Santa Claus Powell's been riding. It's so, I guess, thank you. But I do worry that we just keep delaying the day of reckoning from all these excessively lax policies, both monetarily and fiscal. Now, obviously, since 2022, the Fed has been, since early last year, they've been really aggressively tightening on the monetary side. And it's important to note that they're still tightening because they're doing QT. And people think QT is nothing. I don't think that's true. I think the QT is still a form of tightening. It's just really hard to quantify quantitative tightening. What does it equate to in terms of rate increase? Nobody really knows. And I think because of that mystery, people tend to ignore it, but it's definitely tightening. And just the fact that inflation is easing off of, what was a high level, you could say it's not as low as the Fed wants it to be. And if you look at super core services inflation right now, it's running at 6%. That's a big number. And there is a risk that the Fed, by easing too early, creates a 1970s kind of scenario, which is what they did back then. They thought they kind of had inflation under control. It came down. They eased too early, and then inflation took off again. I think there's a definite risk of that this time, especially with so many secular, structural, or long-term inflationary forcings in the economy, like the great green energy transition. And we're basically trying to replicate a whole new energy infrastructure, but one that's less efficient than the one we had before. And then all the reshoring that's going on and bringing production back into America, which is going to be very, I think very inflationary, at least on a near-term basis. But there are disinflationary things. Rents are coming down. They may be falling here soon. So that helps because that's a big part of the core CPI. And obviously commodity prices have crashed, including energy. So they've got some help right now in terms of trying to be able to pull off the soft landing, but color me skeptical that they'll be able to do it.
Yeah, and it's something I mentioned with Grant as well. It's whether they're just trying to provide maximum optionality. So they're warning about the risk of interest rates decrease in case the economy goes to hell. But at the same time, they're keeping it open where they could, they continue to tighten. If inflation does creep back, then maybe they can. They haven't mentioned that, but I guess they could keep it tighter for longer. So do you think that's sort of what they're trying to do?
Yeah, I think so. I think they're trying to thread a very fine needle, and they have just a Herculean task ahead of them. And you just look at the history of soft landings; they're very rare. And to have one happen when you've got such an inverted yield curve for so long, where gross domestic income (GDI), which is arguably but not much superior at forecasting the direction of the economy. I mean, for example, and I can't remember if we talked about this last time, but last year, the first 2 quarters of the year, GDP was down and GDI was not. And it's just like people got amnesia that GDP actually had 2 negative prints in a row. And GDI said, no, we're not in a recession. Well, now GDI actually is, on a real basis, negative year over year. And every time this happened, we've gone into recession. We've got 19 straight months of falling leading economic indicators. That's another one, 100% track record. We've already had a recession, not only in GDI, but in government revenues, which is turning around a little bit right now. But the deficit is, I don't know if you saw the deficit in the first 2 months of the fiscal year, but it's up like $60 billion in 2 months over what was already an outrageous sea of red ink last year. We ran a $2 trillion deficit, and people wonder, well, how come we didn't go into recession? Well, I'd say that's culprit number one, or at least cause number one, when you have that kind of fiscal stimulus, and especially an economy that is basically fully employed and growing at least decently, or has been. It was a 5% GDP print. Now you could argue maybe that wasn't really fully accurate, but still, it's at least a decent economy. And to have a $2 trillion deficit is it's incomprehensible. I think it's inexcusable, but it definitely prevented a worse economy. But we still had an earnings recession. And as you know, the Kalecki equation is if you have an explosion in government deficits, that's rocket fuel for corporate earnings. So the fact that we've still had an earnings recession despite that is really extraordinary. We've had an industrial recession, transportation sector recession. There's a lot of recessions that have already happened. And maybe that's it. Maybe we get these rolling recessions and we don't have a broad economic downturn. That's possible. But I think you got to be, I guess what worries me now about the soft landing narrative is that it's so broadly embraced. So if it happens, and you can just look at, the financial markets where they're priced. I mean, they're clearly fully pricing in a soft landing or no landing. So if things start to look a little rough, you could really have a very sharp correction. That's kind of my quick overview of the current conditions.
Yeah, it does sort of seem that like maybe there are lots of managers who've been short a lot of the year. They've been absolutely crushed, and maybe they're just trying to get the the last increase before the end of the year to maybe improve their performance. But as you said, consensus seems to be very skewed to the bullish side rather than a balance or even bearish.
Right. Whereas in my case, and my backdrop is appropriate, split personality bull, I think I've got, there's just things that look to me like very good risk rewards and other things that look like very poor risk rewards. And December tends to magnify that because you tend to get tax loss selling of the losers. You get the buying up of the winners to, make things look good at year end, the window dressing effect. And then in January, it often reverses. So I think we could be on the cusp of seeing things like oil rally hard. Gold is already perking. Gold's done fine. It's had L-shaped, had equity-like returns this year, but the gold miners have been very much laggards. You can have a major pop in GDX in January. So, and I think the yen's quite interesting. It's corrected a bit here, but it's still incredibly depressed versus the US dollar. And I do think Japan is stumbling towards the end of yield curve control. I think that's something that Graham believes quite passionately. And if that's the case, the yen could really take off. So there's definitely ways to make money, but I don't think the smart way to do it is to go with the crowd. And I'm like a general contrarian. I don't like to be in things that everybody loves. And, frankly, that was part of the problem I admitted a year ago when I thought we would have a recession in 2023. And of course, again, it depends on what you define as a recession. But that was the group view going into 2023. There was going to be a hard landing recession. Now it's completely flipped. So I'd say it's probably a safer bet now that it's going to happen on a broader basis.
Yeah, it's a good point. So you mentioned there before QT, and we don't really understand the impact it has. Is that the same with interest rates? We think it's going to permeate throughout the economy over a longer period of time. Would you say that you believe QT would have an effect in the shorter term, or is it really the fact that we just have no idea?
Well, if you think about QE, it boosted things pretty quickly. And I think what's different about this QT versus the time back in 2018 into 19 when Powell was kind of timidly doing it and also timidly raising rates is that we've got this, what I call the 4F scenario, the federal fiscal funding fiasco, where you've got to finance that $2 trillion deficit that's actually growing. And we've already seen a lot of dislocations in the Treasury bond market in recent months. Now, this rally since late October is kind of, people do forget very quickly. So the assumption is the long end of the bond market is fine. It's not fine. It's very fragile. And I think that's why the Fed and the Treasury especially has avoided extending maturity. Pretty much everybody on the planet Earth extended maturities when interest rates were very low. The Treasury didn't. I've been very critical of that, but my friend Luke Groman from Force for the Trees says repeatedly that, well, they didn't have a choice because even back then, there just wasn't the depth of bids to go out and sell massive amounts of treasuries. Well, it's far worse now. So that, that makes QT challenging because the Fed was the big buyer of treasuries. Now they're a seller. The big foreign central banks, other than the ones that are kind of hedge funds in disguise. Now there's certain countries and central banks where it's the conduits for the hedge funds. But if you look at China and Japan, they're selling treasuries. If you look at the banks, they're selling treasuries. So it was that was one of my better calls earlier in the year, but you can say, okay, well, things have calmed down, not such a good call anymore. But I still think that is the trend that we're in, is toward a very messy bond market on the long end. Now, we can sell all kinds of short-term treasuries, but trying to finance, and they have limits as to how much they will sell short-term, like 15 to 20%. And they're kind of maxing out, and they've got over the next year and a half, over the next 2 years, roughly 50% of the Treasury balance sheet needs to be refinanced. So it's not just raising new money, it's also refinancing the existing enormous pile of debt. I mean, you're talking like $12 trillion or so that needs to be rolled over. The assumption is, oh, well, everybody will roll those over, but there's some evidence that that's not the case, that some of those folks will say, I just want my money back and I want to go do something else with it. I don't trust your finances in this country anymore, which I think is a very reasonable conclusion.
Could they be tempted with, I guess, um, consensus that the bond price is going to go up. They're going to continue to go up. That maybe there's been a low, and maybe because of that, they're going to buy in and sort of ride the value of the bonds higher. Do you see that, or is that not?
Yeah, maybe for a little while, but I think the long end of the bond market is extremely overbought. And I think if you look at flows into TLT, they were already alarmingly strong. They had been, and they were wrong really up until about 2 months ago. But they've gotten even more frothy. So it's a very crowded trade as far as betting on long-term bonds to play the decline in interest rates. So I think there could be a really nasty reversal soon with, say the 30-year getting back up to the 4.5, 4.75 range, which would probably shock a lot of people. So the yield curve is going to steepen, and I think it's going to steepen by the short rates kind of easing down. I mean, right now, where the Fed funds market is trading, I don't think that's going to go any lower. Probably going to come back up a bit, and the 2 years come down a lot. Maybe there's not too much more there, but I think where the steepening is going to happen is by the longer rates going up. At the same time, the short rates are either stable or coming down a bit. But I'd be very leery of long-term treasuries right now.
Yeah, it's a good point. We saw how quickly it can change when people start unwinding their positions. So it could be the exact same the other way. So if we look at, before you mentioned that we have to get to the point where we sort of discover if this is just a very strong bear rally or if this is sort of the start of a new bull market. So what are you watching to sort of, I guess, decide on what we will see, and what do you think essentially it could be?
Well, a decisive breakout to new highs in the major indices would be indicative that it is truly a new bull market. You got to watch out for false breakouts. I mean, they've happened. 2007 was one where the market made a new all-time high in October, and yet the recession started in December. And there are bright people that think we're already in recession, not just some of these pockets that I mentioned, but a broad recession like Danielle DiMartino Booth. I heard Jeff Gundlach here just the other day, and he was saying it may already be in recession. And I think that's the correct way to look at it. It may be already in recession. That could be behind the Fed's willingness to let the financial markets ease so much. Don't know. I mean, it's going to be, I think it's a tough call. I said that a year ago. I still think it's a tough call because I do acknowledge that there is a lot of monetary or at least market stimulus and fiscal stimulus still. But one of the things is that you're not going to get a doubling of the federal deficit barring a recession this year like you did last year. And you've got the student loan repayment thing kicking in. You've got the end of that crazy ERC, employment retention credit, which was just a fraud-riddled program. So you could be in a bit of a fiscal cliff situation coming into 2024. So it may not be as stimulative from a fiscal standpoint as it was last year. So, and the Fed if they're going to cut, I think they're going to cut kind of slowly and belatedly. So a lot of it depends on the financial markets, and financial markets, as we know, are very mercurial. So who knows? The next time we chat, it could be that we're debating whether it's the bear market's going to keep going. But for now, the bulls are in control. I think you have to admit that. I would expect a reversal in January of some of the things that have done so well at the end of the year and some of the things that have done poorly at the end of the year to change places.
I guess after that reversal, that would be the key, as you said, that would be the key period to understand whether, are they going to go back up and test again and break through, or if they're just going to continue further down. So is that sort of, are you going to watch that specific reaction after they maybe pull back a little bit?
Yeah, I think you could make the case that we're looking at a, potential double top here. But if that double top is taken out, could be off the races. I think one of the challenges for this being a bull move like, say, 2013, when the S&P and the NASDAQ both decisively broke above their 2000 high. That time, the market was cheap. I mean, you had the typical blue chip U.S. stock was trading 11 or 12 times earnings. I think Microsoft was 13 times and Apple about that. I mean, they got down to 10 times earnings, during that period of time, briefly. This time, we've got a much more expensive market. And Mag 7 is obviously very crowded, but that's not where I think the real craziness is. I mean, I was looking at a company, WD-40, and it's a decent company, but they make that the lubricant in those blue and yellow cans. It's not exactly the sexiest product, and frankly, earnings have done very little over the last 5 years. It trades at 50 times earnings. To me, it's just totally nonsensical. And as I mentioned, some of these other companies, well, I guess it was before we started chatting on the record, but you're looking at Carvana, or you're looking at a firm that just lose nothing but money, and their stocks have just absolutely gone ballistic lately. So I think that's where you're going to really get the shakeout.
Yeah, it's interesting because I've heard a lot of people talk about maybe the opportunity, as you said, the Magnificent Seven, their valuation is ridiculous, and there's others that are a lot higher. But the Russell 3000, there are, it didn't have its lowest period at 48 days ago, and now it's at its sort of peak. So that people are thinking that maybe they were undervalued over the shorter term, but potentially they get coming to fair value now.
Yeah, we wrote them up positively back in the summer and in the fall, the small caps, and especially the S&P 600, because I think that's an important nuance. People tended to go to the Russell 2 as the small cap index of choice, but it's 40% of the companies in there lose money, whereas it's only, in air quotes, 20% in the S&P 600. It's a higher quality small cap index, and it's done very, very nicely. Again, I think it's probably a bit extended. I think almost everything's extended, with the exception of some of these things that are getting kicked out, thrown overboard here at the end of the year because people want to take tax losses. That's really been a really good way to make money at the end of the year. Now, some of these things that we highlighted even just a couple of weeks ago have had nice moves, so you got to be careful not to chase even them. But again, I think the energy area continues to be one of our favorites. It got pretty pricey there for a while, gives us a profit-taking opportunity, but with oil, down in the low 70s and inventories adjusted for the SPR releases are extremely low, like shockingly low, which isn't what you hear. I mean, there's so much misinformation that's put out in the oil market about the oil market on a daily basis. It kind of makes me want to tear out what little hair I have left. So I do think that's definitely an area of opportunity, but it's volatile. And so you got to buy it when it's down, be willing to take profits when it runs, which every time I say take profits, people freak out. I don't know why. I think taking profits is a good thing. We typically just trim rather than get out completely. But anyway, I guess my basic point is that not to be bearish, just realistic. And I also think about just the societal backdrop. And I was thinking about this earlier today, that the only time I can think of when there was such societal strife and yet a very frothy, richly valued stock market would have been the late 60s into the early 70s when you had the Nifty 50, where you had a lot of companies trading like WD-40, but they were companies like Xerox and Polar, where they're considered to be the premier companies on the planet Earth. And it lasted for a while. I mean, it kind of happened in the late 60s, and that was the first real tech bubble. And then it kind of popped, and then the Nifty 50 thing came on in like 71, 72, but that era did not end well. Maybe it's surprised by people by its durability, during that 68 to 72 timeframe, but when it popped, it really popped. So I wouldn't take a lot of comfort from that, but it's just odd. It seems like it's one of the times of greatest pessimism toward the future of America by Americans that I've ever seen. And where there's even, the polls are pretty shocking. People that think we could have, quasi civil war coming up, and this election is likely to be one of the messiest and potentially most destabilizing elections ever. And how does that square with a stock market that's acting like things are like the late 1990s when America really was in terrific shape economically and financially? We were running surpluses back then. So I just think, I sometimes say there's the stock market and then there's reality. And they're certainly not sinking right now. Now, which one will turn out to be, the winner in the long run? I think you want to bet on reality, not people's perceptions and beliefs, which can be very, very fickle.
Yeah, if you mentioned, there's been multiple wars, lots of conflict. As you said, lots of, I guess, conflict between people and countries, or just, hey, yeah, there's the markets are close to all-time highs, which is quite hard to believe.
Quite hard to believe indeed. Yeah, what's going on in the Red Sea should be, disturbing. That has the potential to hurt the global economy. And it looks to me like, if you could argue somewhat about America, but it looks to me like Europe's going into recession. You would have a better idea than me, but I mean, Germany is in really tough shape. And, a lot of those big European industrial companies compete with Japanese companies, and the yen is so cheap relative to the euro as well. So they're losing share. And then you've got the Chinese EV manufacturers who are taking market share like crazy, and they can get into the European market. They really can't get into the US market. So that's going to hurt the big European automakers. But China's in I think basically a recession, even though their numbers won't actually show it. But obviously a tremendous amount of economic problems over there, and a bursting of a enormous and decades-long real estate bubble. So it's a global economy, and I think that to believe that the U.S. can totally decouple is naive.
Yeah, I think that's one thing for me why we could see a really strong economy in the future for the US because it has if you look at what's happening in Europe, it's really deindustrialization. So the loss of cheap energy from Russia, um, that's I think that's the number one factor behind that. And then you look at the US, it's the cheapest energy in the world in many of these areas. So we could see a shift from Europe to the US, influenced as well by the friendshoring, onshoring of a lot of this manufacturing. So I think that could be a massive boost in the short term, at least for the US and the economy. That's sort of what I'm seeing. And again, it's hard to believe, as you said, with a lot of those other things in the backdrop, but it just seems to be maybe why we are seeing this massive growth, one-off factor that we might not see again for another 40 years or so.
Right, I agree with that. I think there are definitely pockets of strength in the U.S. economy. We highlighted the XLI, the industrial ETF, back earlier in the year, back in the summer, maybe even early spring, but it's had a big run. But kind of this idea of the reindustrialization of America, I think that is a trend that is in place. It's going to be very expensive, and a lot of money is probably going to get wasted. Although anytime the government gets involved in these big projects, over budget and just a huge misallocation of capital, but for the companies that are, positioned well, the ones that are going to help with that build out, it could be very good. It's a little tricky to find the ones because most of them have other, you can think about a cat or a deer or even a Komatsu that, they've got other exposure. So, they might benefit in the US, but be hurt by the collapse of the Chinese construction market. But there are some that are, somewhat pure plays, and we've done well with one of the aggregate companies that actually was based in the UK that's now relocating to America. So we're always on the lookout for ways to make money, but it's obviously a lot easier when people are scared and bearish and selling blindly, and that's not the case right now, other than with the tax loss selling victims.
Yeah, so you mentioned emerging market debt. So I was just wondering what sort of attracted you to that when you made that investment.
Well, you look at Brazil, for example, which, most Americans think Brazil, and they kind of put in the same boat as Argentina, but they're very different. Brazil has actually adopted probably better policies, economic and monetary policy, fiscal and monetary policies than we have. So they've still got 10% 10-year government rates on their local currency bonds. Inflation's running kind of about where it is in the US, maybe just a tad higher. They run surpluses, trade surpluses. Their budget deficits are a lot less. So, 10% yield sounds pretty good to me in a currency that's, it's being responsibly managed. And there's a number of closed-end funds, and it's tough for US investors, probably tough for UK investors to directly buy Brazilian debt. But I'm sure you've got closed-end funds in the UK that do. Certainly the US has got a number of those that are easy to find, and most of them are trading at a decent discount from their NAV, net asset value. But I will say they've run a lot. One of them is up 20% from the end of October. That's a big move for a bond fund. That's well more than the S&P.
Yeah, I think even if you looked at I think iShares, but they're more equities. But for Mexico and Brazil, they've had a massive run for their sort of equity markets in the past few months, and that's probably a similar trend. The fact that they're better, their central banks are better. Brazil is probably better than Mexico. The US dollar has been very high, so we could see a bit of a pullback there, as well as the fact that they're going to benefit from onshoring and this decoupling between multiple countries. So yeah, it seems like they have benefited a lot over the past few months.
Mexico in particular is that beneficiary of that friendshoring. And you're right, that economy is doing great. The bond market there is, probably reasonably attractive, but I think the Indonesian stock market, or sorry, bond market's attractive as well. And I wouldn't say that all emerging markets are a buy from a bond standpoint by any means. I mean, there's certain ones you just wouldn't want to touch with a 10-foot pole or maybe even a 20-foot pole. But I would say overall, emerging markets are healthier than they've been in a long time.
Yeah, definitely, that's a good point. So, I guess what other places are you putting your assets, or are you looking to put your assets, your capital in next year? I know
So
you.
gold,
Oh, yeah.
gold's done well. It looks to be breaking out. I mean, we were talking about breakouts earlier, and this time it seems like it's holding. Before it kind of got up over 2,000 and immediately fell down. This time it's pulling back and coming right back up again. You've got the foreign central banks, massive buyers of gold for 2 years in a row. U.S. retail sellers, a lot of apathy. That's a pretty good setup where you got people that really know buying and the people that are kind of clueless selling. So I think what's going to really do well near term is GDX, the gold ETF. You can play that either the senior miners is GDX, the junior miners GDXJ. The GDX is obviously a safer play. So I think that's could be a timely one, because if you look, this is one of the things where I think the bulls are deluding themselves, or they're historically blind, is that when the Fed starts cutting, that's actually not good news, unless it is a soft landing. That's where this is such an important debate. So if it is a soft landing, you say, yes, that is, that is going to be lead to the next up leg in the bull market. But if it's a recession, then they cut and cut and cut, and the stock market goes down because there's so many earnings disappointments. Now, the group that has gone up in 13 of the last 14 bear markets and always responds favorably to interest rate reductions are the gold miners. So I think that's, and it's just not popular. People don't care about the gold miners right now. And in some cases for a good reason. They're not as well managed as I've often written and said as the big oil companies, where the oil companies have really, they've got their costs down, they're buying back shares, they're paying out big dividends, they're free cash flow machines, even at relatively low oil prices. So they've done a lot of things to adopt to a less friendly environment than, say, 10 years ago. The gold miners are doing a little bit of that kind of belatedly, but I think what is happening is you're seeing more and more takeovers, and that's a better use of capital than trying to develop new mines, which is very hard to do. There's a few exceptions, but it doesn't matter whether it's a copper mine or a lithium mine. Good luck, trying to get environmental approval. Even in countries like Chile, Chile has been turned relatively hostile towards new copper development. I think that's another area that's interesting. Is copper's corrected, and there's been a lot of problems with the whole renewable energy story here lately, and EVs are getting a lot of pushback, but there's still going to be millions more EVs on the road over the next 5 years, and therefore I think the copper demand is going to go at a higher rate than they could possibly come up with supply. Copper inventories, like oil, very, very low. So our thing is invest in scarcity, and I just don't think there's anything scarce about treasury bonds that can be created at will and by the trillions. And the thing we didn't talk about earlier that I think is, because I get, and I did this for 40 years, the first 40 years of my career, anytime I felt like a recession was coming, and usually it was when the yield curve was inverted, to go with longer duration treasuries. It was just a slam dunk. The problem now is if we get a recession, that $2 trillion deficit is likely going to 4. Some people are saying 6, but I think 4 is very, very doable in a bad sense in the next recession. So where are all the buyers going to come from? It's, we have a set of circumstances like we've never had before. And as dangerous as it is to say in our business, this time is different, I think this time truly is different when it comes to long-term treasuries.
Yeah, it's a scary thought when you say it like that. I think what you were talking about before about the lithium and those other green tech or green commodities is that you mentioned at the start that you want to look at the industries that are out of love, that for some reason other people are writing them off, and then maybe it might not be the time, but just watching them and seeing is there value there, and then can you get in? Because I know I did put a position on in a Chile lithium company and a few others as well, just because I think it could be a potential reversal, but we'll see.
Yeah, lithium stocks have been crushed, worse than copper. Freeport's hung in there pretty well, but you look at things like Livent, LTHM in the U.S., and it's been pounded. It's bouncing a little bit here, but yeah, it's that's where I think you get opportunities, when you get bad performance, but the long-term thesis is still intact. That's what gets us interested. Natural gas is another area that people just seem to hate right now, and talking about what a glut there is. And I don't know. One of the things I think that's really interesting to focus on is what's happening in the U.S. shale basins, because if you don't know, and I think you do know, but probably a lot of your listeners don't, viewers, is that that's really where all the world's growth has come from for energy, both natural gas and oil, especially oil over the last 15 years has been the U.S. shale basins. And they're all declining in production with the exception of the Permian, which is still growing, but that growth rate is slowing way down. And again, this could be a little bit off the radar of most people, but a lot of natural gas comes from the Permian. Not that they're drilling for it, but it's what's called associated gas. You can call it accidental gas. It just comes up with the drilling for oil. And for many years, they would flare off most of that, which was, a huge waste. And now enough pipelines have been built there that you are starting to pull that, to market. And that's a good thing. And I do know that there's some very bright people that feel like that's going to overwhelm the demand. But you look at all these new LNG facilities that are under construction in the US, and our gas is, in the twos, depending on which month you look at. And you look at Europe, and last night it was still $15, per million British thermal units over in Europe. And yes, there's transportation costs for sure, but they're $5 or $6, so it's still really cheap relative to what you guys are paying for natural gas. So and also Asia is a huge user of LNG, and China's getting an extremely cold weather snap right now. So it's with everybody so negative on natural gas, it again gets my contrarian juices flowing. And there's some very good companies in that field. Katera is one to take a look at, and maybe on Antero Resources, but Range Resources I know is liked by one of the best energy companies out there, energy analysts. So I still think, we've reset the table for another positive experience with energy. I think most investors are unaware that in 2022, when tech was down 35%, energy was up 56%. So it got, it definitely had to go through some kind of a cooling off period to set up for the next up move, but I think we've done that.
Yeah, I agree with that. And as you said, it's going to be a shock for the US once those prices sort of converge. If you look at that prices got double or even triple in the or gas at least could double or triple if they sort of meet in the middle. Scary to think.
Right. I agree with you.
Yeah, but David, thanks so much for your time today. I really appreciate it. We've covered so many different parts of the markets. So my last question is,
You're
what is
welcome,
one
Anthony.
message? Yeah, no, thank you. But what is one message you'd like people to take away from our conversation?
I guess, avoid crowds. When everybody's agreeing about something, and that's certainly what's happening right now. I think it was Bob Farrell, the famous technician for Merrill Lynch. One of his 10 rules is when all the experts agree, expect something else to happen. And when you have people like Janet Yellen saying, who's got a really bad track record, we're going to have a soft landing. She said the same thing back in 2007, by the way. So I say, just, avoid crowds and groupthink. And, think for yourself, think, what makes sense, because the market, as I said, this is one of the greatest deviations from reality that I've ever seen. It's supposed to be a discounting machine. It's supposed to be accurately forecasting future events. I mean, that's what the stock market is known for, but it gets things wrong a lot. And I think in recent years and decades, it's getting further and further detached from reality. So that's why I say, don't get so mesmerized by the current price trends and market activity that you lose track of what your own gut instincts and common sense tell you should be doing.
Yeah, it's a good point. And as you said, it's easy to lose yourself during these periods and just get with the euphoria, but it's trying to keep yourself grounded.
FOMO is back. Fear of missing out is back,
Yeah,
despite the fact that that there is an alternative. I mean, there's nothing wrong with these short treasuries. It was a few months ago, T-bill and chill was the rage, and now it's like, oh, that's one thing we were saying is, if you stick with T-bills, they work well temporarily, but they don't lock in a yield. You need to look at things to lock in yield. It was just we felt it was better to do that with corporate bonds in the U.S. or emerging market debt. Unfortunately, that's the way it turned out.
yeah, good point. And I think Bitcoin's the highest performing asset this year at 60%.
Oh, for sure. For sure.
The FOMO is definitely back. But yeah, David, thanks again. If anyone wanted to find out more about your work and what you do, where would the best places for that be?
Substack_Haymaker is the best way to find us. We've got a fair amount of free content that goes out every week. We do greatly value our paid subscribers. Unfortunately, that number is growing. Got a little bit of a momentum pickup here lately, and so thank you for having me on here to be able to highlight that. And I'm sure we'll be talking again in the near future.
Yeah, definitely look forward to speaking in 6 months and seeing. I'm sure a lot of would have happened in when we speak. But yeah, thanks again for your time.
You bet. Merry Christmas, Anthony.
Thank you so much for listening, and if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.